What the market was looking for was an indication from Jerome Powell, which he gave very clearly today, that they are going to cut rates because of the weakening in the employment data, which you and I have been talking about for months now.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap with my very good friend, the inexorable portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing good for a Friday. So it's been an interesting week. Kind of today's very interesting. It's one of the largest. It actually is the largest August options. I'm gonna spit that out in a second here. It's the largest August. Say that three times fast. Options expiration day in history. It's like $3 trillion today. So you've got all that going on. Then plus, of course, you had the Jackson Hole Symposium speech by Jerome Powell this morning that sent the markets just tearing off back to all-time highs. So it's pretty crazy, after a whole, just headline after headline after headline that oh, the AI bubble's over, and it's all coming down, and there's all week long was these really negative headlines, and then one speech and the market's back to all-time highs, tech leading the way. So everything everybody was concerned about now in the rearview mirror.
All right, well, look, that's where I want to start. I did pick the word inexorable, which, just to remind folks, means like a fait accompli, like it's almost unpreventable. It's something that's going to happen. Um, uh, there are some inexorable or some forces that appear to be inexorable that are in play, Lance, and I'm talking about the slowing of the economy. I'm talking about where inflation is likely to head. I'm even talking to a certain extent about the stretched valuations we have, and at some point that there might need to be some sort of correction to bring them back into better alignment. But that being said, inexorable doesn't seem to apply on a day like today.
It really doesn't. And speaking of, this weekend's Bull Bear report is all about valuations and what they mean short term and long term. So if you haven't subscribed on X, you can just go to my @Lance Roberts on Substack. I'll post that out on Saturday. But I'm gonna go through kind of what valuations mean short term, because they're expensive. I mean, price to sales at 3.2 times price to sales for the S&P, highest level on record, multiple price to book, market cap to GDP, all at record levels. But doesn't mean anything in the short term. It's all about sentiment, and valuations are only a reflection of sentiment in the short term. Long term, they matter very much. It's all about returns long term. But in the short term, valuations are telling you exactly what's happening in the markets right now.
Okay, so we will get there, and I also do want to give you a chance to walk through your recent piece that you have already released on your site about the risk to earnings that
Yep.
recent data is showing us, and of course, as we talk about a lot, but you say all the time, it's all about earnings at the end of the day, right? And a lot of today's earnings just seem fairly mathematically unrealistic. But again, sentiment is in the driver's seat right now, right? So
Exactly.
let's start with Jackson Hole.
Okay.
I guess so. In preparing for this morning, I actually didn't get a chance to watch live, so I don't know exactly what Powell said. I just know that the markets loved it, so it must have been relatively dovish that, hey, I think we probably are going to cut. What I will say, and let you react to this in your answer, is, I mean, Lance, wasn't the market already pricing in several rate cuts this year? So, like,
Of
what
course.
about what Powell said made people even more optimistic than they were before the speech?
No, and look, this is the one thing that we've really all got to get away from, is that, markets are pricing in all this stuff. So the markets were rallying to all-time highs on the expectation the Fed was going to cut rates. We sold off a bit this week going into that just in case. And then basically Powell delivered exactly what the markets were previously expecting. So now markets are back to where they were previously. But look, in the short term, again, you have two things going on today. There was a lot of concern earlier this week. Tech was selling off. But let me remind you, here on the show last week or the week before, I can't remember, Adam, it was either last Friday or the Friday before, I went through Simplevisor and I showed you how healthcare was very oversold and technology was very overbought. And we said, hey,
Yeah.
this leads to rotations in the markets. Well, over the last week in particular, but actually starting the week before, that rotation occurred. Healthcare has been performing great. There's been healthcare has gone from very oversold back to more kind of neutral, but starting to move into overbought levels. Technology worked itself from being very overbought to very oversold. So we saw that exact reversal occurring in the markets. And of course, everybody was like, oh my gosh, the AI bubble's over, all these headlines and, tech, look at what, Palantir, they're just this report came out and Palantir's down 10%. Palantir moves 10% in a day all the time. I mean, it tells you nothing about the stock. It's just a very volatile stock. But again, that wasn't surprising. And a lot of that action was all these options traders getting ahead of expiration today, selling off positions, replacing positions, getting their options in place for this Friday's expiration. So a lot of that action that occurred this week was just technicals. Markets were, technology was very overbought, very extended. It needed a correction. That's all that's happened. And now we're starting to reverse that trade today on expectations the Fed's going to cut rates. Lower interest rates, better for corporate earnings. Lower interest rates, better for high beta stocks like technology stocks in particular. So those stocks are performing well today on the expectation the Fed's now going to resume their rate cutting cycle.
I'm curious, this is just postulating, but does this set us up potentially for when the Fed does actually cut, it be kind of a sell the news event because everybody bought the rumor?
Well, yeah, that's, buy the rumor, sell the news happens all the time. This is pretty far out. The meeting for the next rate cut is September. Don't quote me. I think it's the 15th, 16th of September. It's that Tuesday, Wednesday. So it's still a ways out. And again, just this is a 1 day bounce. Market's gotten oversold short term, so you're getting a bounce today. It's a very sizable bounce. On a factor basis, small cap, mid cap, largely outperforming today. We talked about last week, we on Simplevisor, we launched all these different portfolios 2 weeks ago. And they're it's a very interesting setup because these thematic models are like factor markets. And so there's a small cap, mid cap, that portfolio is up sharply today. The high dividend yield, which has been performing very well over the last week, because of that rotation to defense, is lagging the market. It's up today, but it's still lagging the overall market because it's not in those higher beta names.
Right.
So, when you take a look at that factor performance, it kind of really tells you that money is moving back from defense to chase all the offense. So basically buy the dip is what's happening in the markets today.
Sure. And, we're seeing, I mean, pretty much everything go up. In particular, crypto.
Yeah.
And crypto is, so far at least has been very, extremely risk on. And so this is a sign this is a risk on day, right? High beta.
Yep. Yeah, no, yeah, there's a very high correlation. I actually, in our daily market commentary that we publish every day, on Wednesday, I believe, I was talking about the correlation between Bitcoin and the NASDAQ. And there's a very, very high correlation. They trade very closely to each other. And Bitcoin had been selling off, and Bitcoin tends to lead the NASDAQ. So that sell-off we had in the NASDAQ was really not surprising because Bitcoin was already telling you that risk-off trade was occurring. And so to your point today, it's all risk back on again. And so Bitcoin's doing very, very well today. Bitcoin's up
That's 3-something%.
yeah,
Like
3.5% right now, back to 116,000. Small cap, mid cap stocks are up about 326. Sorry, they're about 4.1% now. So so all the risk on trade. You got to remember, small cap, mid cap. Most of those stocks in that small cap, mid cap space are unprofitable tech. So those are the ones having the biggest gains today. So it's just basically buy risk on. So everything that was, again, hiding over in defense over the last really week and a half is moving back onto the offense field today.
Okay. So I want to ask you a question about, because
Sure.
you have been saying, hey, look, it's not a sell everything moment by any stretch, but just be prepared for a correction at these stretch levels. Obviously, the rubber band is now getting really stretched again. Before we get there, though, a couple quick things. One, I did look up while you were talking, the next FOMC release is going to be on September 17th.
Okay, so 16th, 17th is the meeting.
Yeah,
I missed it
16th,
by
17th. Yeah. No, it's okay. Just want to make sure folks know
Yeah.
it's a Tuesday, Wednesday. But beyond I guess, intimating that a cut is likely in September. Did Powell say anything else to justify this kind of, market reaction by the markets?
Well, this is, what he said today was pretty much what we've been saying now for the last 3, 4 weeks. I've written a couple of articles about why the Fed, why Jerome Powell was behind the curve. And this is really kind of part of the article that's out today, talking about how the economic data certainly doesn't support earnings growth, and that economic data has been weakening fairly substantially over the course of the last couple of months, in particular. And heading into that last meeting, I said that look, the Fed should be cutting rates now. The longer they wait to cut rates, they risk getting behind the curve. And so really what Jerome Powell said today and what sparked the markets was he specifically focused on the employment data. And he says, hey, that employment data has been 35,000 jobs on average over the last 3 months. It's much weaker than we anticipated. We haven't seen it go into the tightness of the labor market yet, but that's what we want to avoid. So he pretty much just stated that they're going to start cutting rates again. Now, the question becomes, is it just one cut and they're done? Is it two cuts this year? Is it three cuts this year? How many is it going to be till the end of the year? That's going to be the next big debate. But what the market was looking for was an indication from Jerome Powell, which he gave very clearly today, that they are going to cut rates because of the weakening in the employment data, which you and I have been talking about for months now,
I was going to say,
right?
I mean, quarters. We've been talking a long time about
Yeah,
how the data just seemed to not be trustable, and that it seems skewed upwards. And then of
yeah,
late, we've been saying, look, there's more and more cracks that we're seeing. Yeah.
absolutely.
Yeah. So hooray us. Okay, so let me just take this into a direction I think you'll like, Lance. So I released a special video this morning. So we're recording on Friday as usual. I usually don't release Friday videos, but I did because I was able to get a hold of Steve Hanke. And Steve is, he's a longtime professor of economics at Johns Hopkins, but he's really like zeroed in on inflation, right? And at times people have said, "Hey, Adam, you should get Steve and Lance to debate together," and wasn't able to make that happen this time. But I did want to get Steve's thoughts heading into Jackson Hole, and he basically says, Lance, he approaches inflation from a very academic standpoint. He relies very heavily on the quantitative theory of money. He has a pretty great track record of predicting inflation using that formula. He predicted well in advance that inflation was going to get up to 9%. And I know he predicted this because he did it in an interview with me,
Mhm.
probably about 5, 6 months before inflation rose that high. And at the time, people thought that that was just totally not believable. And he pretty much pegged it. When inflation hit 9, he said, all right, look, it's going to start coming down pretty materially, again, leveraging or leaning on the quantity theory of money. And he proved to be right there. So I asked him his thoughts about Jackson Hole, and he said, you know what? He said, I predict that everyone's going to focus on the wrong thing on Jackson Hole, which is what's the Fed going to do with the policy rate. And he said, it's actually that's looking at the wrong lever. In his mind, it's all about money supply. And it's not just about whether the money supply is increasing or decreasing, it is the rate at which is it increasing and decreasing. And basically, based on his calculations, he said that the money supply, the current money, let me see if I can get this right. The money supply growth rate that supports getting inflation to the Fed's 2% target is 6%. But right now, the money supply growth rate is only 4%, meaning that disinflation is going to be in control until and unless money supply grows faster than it's currently growing. So he's basically saying, like, look, it's almost kind of immaterial what the Fed decides to do with the policy rate right now. The money supply factor is going to bring inflation down from here.
Right.
How much
No,
further down from here? I know you're going to say you think very similarly, right? This wouldn't have
yeah.
been much of a debate. This, I think, would have been a really, interesting mutual agreement discussion had you been involved in it. But basically, here are his punchlines. He thinks disinflation is going to be in charge. He thinks the economy is going to continue to slow. He thinks the odds of it slowing into recession, Lance, are pretty good, just FYI. Despite inflation coming down, right? Despite CPI coming down, he doesn't see bond yields coming down very much, and that might be a place where you two differ. Um, so he says, look, if you're betting on bond rates coming down, bond yields coming down materially, I'd slow your roll on that one. But anyways, I wanted to give you kind of his general view of things, and I don't think he'd be that surprised by what Powell said today, but I think he would say it's almost kind of immaterial because you got the quantity theory of money and money supply in the driver's seat, and that's bringing things down.
Right. And I guess you have to ask him the question, what does he mean by materially? Or is he talking about, bond yields going to zero? That's not going to happen. Bond yields going to one, that's not going to happen. Bond yields getting to 2.5 or 3, that's probably going to happen.
Okay,
So
and I think that's where you and he differ, because I got the sense he was like, they're not going to really go much below 4. They're going to kind of hang out where they still are. So
so bond yields are a function of inflation and economic growth. So if you have a recession and disinflation, you're going to have lower bond yields.
I
So bond yields
talked about this, and I don't want to get stuck in this debate
Sure,
with you
sure.
because I'm not the right guy, but his response to that was there's still so much uncertainty about tariffs and trade and everything like that that the bond market
doesn't care about that.
On it.
Yeah, bond market doesn't care about that. Okay. Bond market only cares ultimately at the end of the day about the economic growth and inflation. So there's a lot of that thesis out there. It's like, oh, well, there's this impact and that impact, and that leads to what we call term premium, and that's just sentiment. So as soon as sentiment fades, and we're seeing, like the whole tariff impact hasn't shown up, and the bond market's starting to get well past that now. But yeah, so I mean, if you see, if economic growth goes to about 2%, or if we have an inflation, a disinflationary environment, bond yields are going to have to come down. Again, they're not going to go to 1. They're not going to go to 0.5% like we saw in the pandemic, unless we just shut the whole economy down. But 2.5, 3.5% is going to be about where things, kind of that's what we call the terminal rate for bonds, and that'll be where basically bonds you have maximized the gains in your bond holdings, and that's where you'll sell treasuries and move to something else.
Okay, and I understand that is your point of view. I interviewed Jim Sturzo from Research Affiliates earlier this week, who feels very similarly to you. It would be interesting perhaps to get you and Steve to talk about this, and it might be a little bit of a difference between the academic and the guy that's in the trenches, and which wins out.
Yeah,
but I felt as he was talking, I felt like you and he were pretty much in lockstep right up until bond yields. Yeah.
Yeah, no, and it is. It's from a academic standpoint, he can make that case he makes is completely valid. I'm not arguing the point. There's just a different way. Since we work in the bond markets every day, it's a big part of our job. There's a very different structure about how bonds actually work versus the theoretical frameworks. And it's because the bond market, like everything else, is driven by people buying and selling and adjusting for what the opportunity costs are. So, sometimes that's why academic theory and actual markets don't always disagree. And that's what happens all the time. But back to your bigger point, here, I'll share a chart with you. He's absolutely right about money supply. And the big problem that people have when they talk about money supply is they talk about, money supply is going up. It has to go up. The money supply always has to go up because that's where economic growth comes from. If your economy is growing, your money supply, the amount of money you have in the economy, is going to continue to grow. The question becomes, is the money supply growing faster than economic growth? In other words, there's too much money in the economy, or is it growing slower than the rate of the economy? So, you have to always look at this in terms of monetary supply as a function of the economy. So this is just straight into, blue line is straight into gross domestic product.
Sorry to interrupt. Can you just increase the chart as you're talking to it? For our site challenged boomers. Yeah, thanks.
Better. So yeah, the red line is gross domestic product. This is nominal, right? This isn't real. This is just not, this is all not, M2 is nominal and gross domestic product is nominal. So you'll see though, that as the economy grows, money supply grows. Has to. It's a function of economic growth. You cannot, if you have no money supply growth, you have no economic growth. It just can't occur. So you have to look at this in terms of what is your money supply relative to GDP. If your money supply is growing faster than economic growth, you got a problem. If it's not growing as fast as economic growth, you got a problem. The question is, what problems do you have? One is inflation. If it's growing faster than the economy, you're going to have inflation. Slower than the rate of the economy, you're going to have disinflation, which is why inflation has been falling ever since that peak of 9% in inflation. So even though M2, the blue line, has continued, and basically M2 is about where it was coming out of 2020, 2021, when we just injected the economy with all kinds of money. But that's what caused that monetary spike because you had this massive surge in money supply faster than the rate of economic growth. Since then, money supply has fallen sharply as a function of the economy, which is why the economy is slowing down and why you're having disinflation. So he's absolutely right about the thing you should be looking at is M2, but as a function of economic growth, not M2 nominal. That's a very bad indicator to look at.
Okay, yeah, and there have been people out there saying, um, no, inflation's going to come because M2 is rising, and therefore it has to, right? And to your point, no, it's all about the relative rate.
Right. Well, no, and look, we want inflation. Here's the thing that I think a lot of people misunderstand. When we talk about inflation, we throw it in one bucket. It's like, oh my God, inflation. We want inflation. We do not want disinflation. Disinflation or worse, deflation is very bad. You don't want that because that impairs the economic livelihoods of everybody. Job losses, everything is bad in a deflationary environment. That's quote unquote the depression. You don't want that. We
Yeah.
want inflation. We want 2 or 3% rate of inflation in the economy because that means the economy is growing. You want increasing rates of money supply because the economy is growing. Everybody benefits from that. You don't, if you have no money supply growth, you have no economic growth. If you have no money supply growth, you've got you have basically no inflation. And if it shrinks, if a lot of this, if a lot of people got what they wanted, we cut out all the deficit spending and got rid of the debt, you'd have a depression because we have a very large chunk of our economy dependent on deficit and debt spending because that fuels bank accounts for individuals like Social Security, Medicare, Medicaid, all that comes from the government. That's the debts and the deficits that come in. All your defense spending, all the money that gets spent for Lockheed Martin, Raytheon, all these companies, that comes from the government. That pays payrolls and salaries and benefits and all those type of things for the employees in the economy. So the function of money supply is very important, and the rate of that growth is very important for the economy. Now, again, if it's growing much faster than the rate of economic growth, that's when you get debasement of the currency because you have too much currency in the markets at one time, and that creates debasement. But we don't have that right now.
So I understand what you're saying, and I agree with the spirit of it. I just want to make one qualifier because I can hear the screams of people watching this,
Sure.
which is disinflation, deflation. They have their moments in the natural cycle,
Mhm.
right? And when you have too much intervention, especially when that intervention, is done to try to, as I like to say, delay winter from ever happening, right?
Right.
Then the system gets deformed and distorted. And so, and then you get everybody saying, well, look, we can't ever now have disinflation or deflation because it would be too catastrophic, right? And so we got to try to just keep things permanently distorted forever, which requires more and more intervention. And so all I want to say is there are times maybe in a natural system, there are times where you want some disinflation and deflation to kind of,
Yeah.
we,
It's
we,
called
we,
a
we
recession.
yeah,
And
a healthy
and
recession to
we
get rid of
want
the malinvestment and whatnot, right? Yeah.
exactly. We want, and this is and look, this is where I absolutely disagree with the Fed. I've been very vocal about this for years. It's stop trying to stop recessions. Ever since 2008, everybody got so flummoxed by the 2008 financial crisis that it's like, oh my gosh, we can never have that happen in the economy ever again. So they've gone to these extremes of quantitative easing and zero interest rates for way too long and all these other type of things to try to keep recessions from happening. But recessions, when normal, right? 2008 was a abnormal environment because of the whole financial crisis, the bankruptcy of Lehman, all that. A normal recession, which we haven't seen one of those in a bajillion years, is actually good for the economy. It helps reset the table. You get some disinflation, things come down back to normality. You get a housing market correction, those type of things, and it allows the economy to function. And for up till 1950, we had recessions on average about every 4 or 5 years, which was okay. And then after about 1970, we started really spanning out the average recessionary period to 8, 9, 10 years. And that's just really too long. It creates, to your point, creates too much, malformation within the economy, because you need those resets on, you need corrections in the markets, and you need recessions. You just
Right.
don't want depressions.
We,
You don't want the abnormal recessions. You need normal recessions.
right, right. Well, I guess, and here's my academic question for you, Lance, which is, because the system has been so heavily distorted for so long, you know, do we sort of almost need a depression to get back to a sustainable baseline, right? Can we get
Yeah.
there just with normal recessions going forward? I don't think so. I mean, if we just put it this way, if we just let normal market forces head their way, I think
Mhm.
we'd have a depression.
Well,
Hope it wouldn't
probably.
be.
Well, yeah. No, if you stepped in and said, "Oh, if Adam was king, right?" And you stepped in and you said, "Okay, no more deficit spending, no more debt increases. We're freezing the debt where it is, and we're
No
going to
more
cut spending.
QE, no more interest
No
rate
more
monkeying.
QE. No, yeah, we're going to get rid of the Fed. No more QE. Nothing. You're going to have a depression, right? There's too much dependency in the economy for those supports. You have to wean it off, right? And you'd have to create mini recessions over a period of time, like, just almost, cut your policy at a rate that almost ensures kind of almost like a Japan scenario, where you have kind of rolling recessions every 3 years, and that would take a period of time to kind of work you back towards a normal environment. You would be, since you're king, we can't depose you, so you would just actually be murdered for
Right.
doing that. But
I would build a very deep bunker. Yeah.
exactly, because you're going to cause a lot of economic pain, and you're going to destroy a major functioning piece of the economy. And this is the misunderstanding that a lot of people have about debts and deficits. They are they're no longer a bug, they're a feature of the
Right.
economy. And when you
You
start
pull them
trying
out,
to,
the patient goes into violent withdrawal. Yeah.
yeah, and it's more like pulling life support. you
Yeah.
know and we don't have any medical directives
Right.
right now for the economy, so
So this is the knife's blade that we have put ourselves on here,
yeah,
right?
absolutely.
As you look out further, right? It's like, okay, on one side is, a depression of massive debt defaults, right? Which really nobody in power is going to willingly choose, unless you all make me king. And then on the other side is currency destruction, right? I mean, that's the long-term cost of the constant intervention that we're doing, right? It is the purchasing power of your currency just gets more and more inflated away.
Right.
Yeah.
Well, but again, you have to keep that in perspective too, right? There's this huge body of people out there is like, oh my gosh, the purchasing power of the currency is being inflated away. Yes, that is a good thing. You want that to occur. But see, what that assumes, Adam, is that you took all your currency in 1970 and stuck it underneath your bed, and you never did anything with it. And so, yes, that $100 you put underneath your mattress in 1970 has lost about 90% of its value, right? And that's
Right.
that famous chart. I think I even
I
have a
think even
copy.
more, but yeah, go ahead.
Oh, here, I've actually got a chart of it. Give me a second here. This is the chart everybody shares, right? This is the purchasing power of the US dollar, 90% decline since 1966. Okay.
Okay. I thought it was more, but okay, go ahead.
Okay. So, but that's a good thing, because that means that the economy's been growing. We've been having inflation. People are wealthier than they were in 1960, all those type of things. What this assumes is that when everybody shows this chart, they generally the people that show this chart are the ones trying to sell gold to somebody. So, but you want that you want that. All this is, and this is the graph everybody shows, but all this is the inflation adjustment of the dollar. Let me find it here. It's the same exact chart. This is just the dollar measured against inflation. So inflation has gone up. So this assumes that you never invested any of your currency in 1966. It just sat there. So this is why it's so important that we adjust for our purchasing power parity of our dollars by investing them in things that grow faster than the overall economy. And so when we take a look at something, so this was Peter Schiff did this, right? So Peter Schiff's, big gold bug.
Yep.
And he wrote this whole article about, well, if you'd invested all your money in 1900, back then it cost $41.42 to buy two suits. And so if you had invested your dollars in gold back then, fair statement, right? Because gold has gone up over time, then you could have bought, five suits. Well, so here's gold versus the S&P. Which one was a better inflation adjustment since 1900 to maintain the purchasing power parity of your dollars? If I invested in gold, my $41 in 1900 is worth $3,600 today versus $30,000 or $31,000 if I just invested in the S&P 500. So again, it doesn't matter where you invest those dollars, but the big misstatement is this loss of purchasing power parity of the dollar. That's only true if you never invested your capital.
So I get what you're saying, and I actually don't want to potentially rat hole on this. So let's first start where we agree. The opportunity and onus on us is to invest our capital to grow at a rate faster than the
Inflation.
economy and the inflation rate, right?
Right.
So I'm
Which is
totally
why,
there.
which is the whole reason why we invest in gold or in Bitcoin or in stocks or anything else.
Right. And as
We
we've talked
forget
about,
that because
that is what you have to, that's got to be your starting point when you invest, which is I'm investing first and foremost to at least keep pace with that purchasing power debasement, right?
unfortunately, though, now we just turn markets at the casino, so we don't invest for that reason anymore. We invest to see how fast we can get rich, right?
Exactly.
But the real reason that we invest is to maintain that purchasing power parity of our dollars. That's why we invest in any asset class.
Yeah. So I'm there with you. I could have a whole other discussion with you about, is the rate of inflation that we've had over much of the past year, especially over the past 50 years, is it the right one, especially given all the intervention? You said it's a good thing. I think that's a dangerous thing to say, blanket statement wise, and also it makes a really big difference whether you have assets or if you don't, because those that don't have a lot of capital to invest get absolutely crushed by all the bad of that inflation and none of the good. So there's a lot to be had there. And I'm saying some of the slants because I'm sure people were screaming at certain times here, and I don't want to.
Yeah, and let's not be extreme, right? First of all, let's not go to massive extremes. First of all, a lot of people that don't have money invest is a lot of their own fault, right? Because they
It
don't
is, but labor has definitely suffered.
Hold on, let me finish. Yes, 20% of the population is poor. There is every population throughout history is going to have 20% of the population.
You're going to have the Pareto principle.
Poor.
I agree with you.
Exactly. The middle class, they have money to invest and savings to invest, and they do that. They have 401k plans, they have other stuff, but a lot of their problem is that they spend way more than they make. And this is why they're heavily in debt. And a lot of those are personal choices. The environment did not do any of that to them. But when we're talking about inflation, we're talking about the rate of inflation of economic growth as measured. Now, people can run around all day and say, yeah, but this gauge says it's 50%. Or, if I go back to looking at the way we calculate inflation back in 1900, it was different than it is today. Yeah, there's all those things. So however you want to settle on your personal rate of inflation is entirely up to you. But the bottom line is if you don't have inflation, at least at the pace of economic growth, you're not having economic growth, because inflation is a function of supply and demand in the economy. And if you want economic growth, which leads to prosperity and leads to more money in your bank account, you want inflation that runs at least at the rate of economic growth.
Okay. And I'm going to end this just by saying I agree with you. We want that economic growth over time. Let me get to the question I was hoping to ask you, which is, just pretend with me for a moment here, right? Where, it's always fun to think about key moments in history and say, what would happen if this worked out differently, right? So if we could peer into a parallel universe here in 2025, a different universe, where we just let things correct in 2008.
Yep.
Where
I've said this for years. I've said this for years.
Yeah. So we let the city banks fail, right? I mean, we let a lot of these too big to fail banks fail, right?
Which you should have.
My guess is we would have had a really rough 2008, 2009, maybe even 2010, right? It would have been, a financial winter, a nuclear winter. It would have been painful. A lot of people would have lost their jobs. But we would have gotten over it, and we probably would have gotten over it faster in retrospect than we thought it was going to take, right?
Right.
And
And you
we
wouldn't have the
would,
wealth gap. You wouldn't have a lot of this other stuff. You wouldn't have five banks that make up 60% of the banking industry.
yeah,
You wouldn't have any of that.
you wouldn't have moral hazard of
Mhm.
corporations doing things they shouldn't do because they know they're going to get bailed out, right? I
That's
mean,
right.
how much better would the economy and society be today, whatever that is, 50,
15 years.
17 years afterwards or
17
whatever?
years after, yeah.
Yeah,
Well, you figure 3 years for a depression, so say
yeah.
15 years. Yeah.
Okay. Yeah.
But no, look, absolutely. I've been saying ever since the financial crisis, I've been saying this is that the worst mistake we made was bailing out JP Morgan and Goldman Sachs and all these guys. You got yourself into this mess. This is why we have capitalism. But see, everybody was afraid back then. It was like, oh my gosh, if these companies go bankrupt, what is it? That's going to ruin the economy. No, that's why we have bankruptcy laws. All
I'm going to get
bankruptcy.
voted out of office.
Right. Well, bankruptcy doesn't mean that companies go away. It just means that they restructure.
They get
So,
recapitalized. Yeah.
yeah.
Or
So
their operations get absorbed into other companies that were smarter. Yeah.
which we saw a lot of that happen, right? We saw companies get, Washington Mutual, got absorbed, Merrill Lynch got absorbed by Bank of America. So, but you got yourself into this mess, and so you're gonna have to. Sorry, we have bankruptcy laws. You have to restructure. Your shareholders are gonna get zero. So if you invested in Goldman Sachs, sorry, partners of Goldman Sachs, your equity is now worth zero. Debt holders get paid off with assets. And then the company restructures, come out of bankruptcy, and they resume operations. Leaner, meaner, none of this, kind of legacy tied to them. You wouldn't have five banks making up 60% of the bank or 70% of the banking industry like it is today. So you'd have much better competition across banking. A lot of these mid-sized banks would have absorbed all the accounts. So when Goldman Sachs went out of business, like, oh my gosh, terrible. Well, no, all that happens is that Merrill Lynch gets some of those accounts and Schwab gets some of those accounts and Fidelity gets some of those accounts that weren't involved in all of your hanky panky.
Right.
They're
Or,
going
or,
to
or smaller independent firms like IRA get more of those accounts, right?
absolutely,
Yeah.
absolutely. And so, everybody was so afraid that this was going to cause this massive economic destruction. And yes, there would have been a lot of economic pain, lots of job loss. Goldman Sachs goes out of business, JP Morgan goes out of business. They're going through bankruptcy, lots of job losses, lots of destruction. Yeah, it's going to be really rough for a couple of years.
But
But
then
they're going to
probably more jobs in the long run with a healthy economy afterwards, right?
exactly. Well, that's the whole point, is right.
Yeah.
So you have this economic devastation, and from that, everybody rebuilds. You now have a much broader financial base of banks that are operating within the system. Companies are leaner and meaner. They've gotten rid of a lot of their debt. They've gotten rid of a lot of their overhang. All the bad stuff they were in has now been cleared off the books. So now they're lean, mean, and healthy. They come out of this. They're going to start hiring people like crazy. The economy is going to take off running. Markets are going to start to recover. Instead of a 50% decline, maybe it would have been a 70% decline in 2008, right? But now you wouldn't have a wealth gap. Instead of 10% of the people owning 90% of the assets, maybe you have now 50% of the people owning 90% of the assets. Everybody's better off. But again, we don't want to, but no, but it's all theoretical. It's all hindsight, right? Nobody actually wants to go through that. Everybody talks about, and this is what cracks me up about all these people, talking about the end of, the end of the world is coming. They're doing that to get clicks and views. At the end of the day, they don't want that any more than anybody else because they won't have a job. And it's like this idea sounds romantic in nature. We have this massive global reset, and everything's going to be honky dory. But nobody really wants to go through that because the pain of that is going to be very traumatic. We're going to have poverty rates of not 20%, but 50%. We're going to have massive homelessness. We're going to have just a tremendous amount of economic devastation while we reset the system. And that's just something nobody wants to tolerate.
Well, and yeah, nobody in power is going
Yeah,
to
nobody in power
proactively.
will be in power.
Well, but they're never going to proactively choose to go through that. And I agree that, look,
Right.
be careful what you wish for, right? If we get this system cleansing, which, I mean, honestly, intellectually, I'm all for it, right? I'd rather take the pain and just get to someplace a lot more sensible and sustainable and fair. But
Well, that's
but I'm
yeah.
smart enough to say, as I'm going through it, I'll have changed my mind and say, I wish I hadn't chosen this, right? It'd be terrible. Yeah.
but the difference is like probably you and your family could probably weather something like that. You've got money in the bank, you've got savings, you've been investing, you've got a cushion.
Well, I know a guy who gives hard money loans, so
Yeah, and you know a guy that makes hard money loans. Um, boy, my rates are going to go up a lot. So just thinking about that. But yeah, I mean, you'll be okay. You've got to think about the 80% of the population that is one paycheck away from basically losing their house.
Oh, it'll be
You know,
absolutely terrible. The point I was just going to make is as bad as a case as you could make for how 2008 would have been had we just let
mm,
the system cleanse. Way worse. Hard to imagine it would be way worse now.
yeah. But see, this is where I think the Fed made, I think this is where the White House made a mistake. So remember, Obama was president back then. And we did the
Very
HARP,
newly, but
we did
yes, yeah.
HAMP, we did HARP, we
And
did cash
TARP.
for clunkers, cash for appliances. We did all these type of bailout programs. We did TARP, which was the infrastructure that was 800 billion, and then we started to have the Fed step in with QE and all these other things. In my opinion, the better thing would have been to do is first of all, so let's say we're gonna not let all these banks go into bankruptcy, right? But instead of letting JP Morgan swallow up everybody on the block, which they did, is really, proactively think about, hey, what are these consequences of us doing this now? Kind of do a little bit of forward thinking. But then secondly, not providing all that support, not doing QE, leaving interest rates where they were. Interest rates were running about 4% back then on the 10-year treasury. Keep interest rates where they were for the most part. Don't cut rates to zero with the Fed. Don't do those type of things. Don't overstimulate. We just overstimulated the economy. We basically gave the market cocaine and got everybody addicted to cocaine at that
Right.
point. But then that would have and yes, that's where, what we said earlier, Adam, we would have had the financial crisis, had a bit of a recovery, another recession, probably 2, 3 years later, a bit of recovery, another recession 2 years later, a bit of recovery. And then by that third or fourth cycle of that, the economy then is going to be back on its feet. Housing is going to be back under control. We won't have this housing bubble that we've got now. Housing is going to start doing what it's supposed to do, which is running at about 3% annually on growth, about the rate of inflation. So all those type of things will return to the normality that we saw from 1900 to 2000, or really 2007, about the way that house prices grew, the way that insurance rates grew. Get government out. Government should have never been involved in student loans. All those types of things that the government got involved in got malformed, and that's what's
Yeah.
caused all these problems we have today. And we wouldn't have any of those problems if we just let, to your point, just kind of let normalcy enter into the picture. And then the government could have stepped in and done some bailout programs, right? You could have done a TARP. You could have done, some other, type debt programs to help, kind of stabilize, kind of Keynes, right? During an economic recession, government spends. So as you're going through this, the government spends some money, kind of helps stabilize recessions, but we don't do all this other stuff that created all these malformations.
So I'm right there. And look, I do want to get to valuations in a second. But interesting. This is a good, interesting academic exercise. And
Yeah.
I'd like to think that King Adam, what he would have done is said, all right, we're just going to let natural market forces do what they need to do, right, to get us to a true water line here
Mhm.
economically. But to your point, sort of like to the extent you have a central bank, at a minimum, it should serve as a lender of last resort, right? The government should step in and try to, what role do you want it to have in a depression, right? And rather than bail out all sorts of different players, what I'd love to see is sort of like, and this might be a naive thought, but I'd love to just sort of see government works programs that invest in the future productivity of the country.
Mhm.
And
Yeah.
so the modern equivalent of the shovel-ready, let's build a new national highway system. So maybe this is let's rebuild the electrical grid. Maybe it's let's rebuild our decaying bridges and roadways, whatever it is, so that anybody who, is out of money and needs to eat can come. They can do an honest day's work. They can get paid enough to, afford to feed their families, and weather these rolling recessions that you're talking about. That over time will get less and less, and then we get to the
Yeah.
right. But that way,
So
there's no
John,
malinvestment left over. There's no, you're
yeah.
not even really competing with private enterprise. You're building like national infrastructure that will be used for the entire economy to benefit from in the future.
Yeah. And that's something you and I have talked about for ages, is that, that's where government, there's only two things the government should be doing, which is
Defense.
basically, yeah, there's national security, right? And infrastructure. That's their job. That's their only job. All this other stuff, education, healthcare, the Affordable Care Act, that's not the government's job. That should
It's
have
all
never
it's all
been.
mission creep for the most part. Yeah.
Exactly. But yeah, absolutely. We did this we've talked about the Hoover Dam before. We talked about Tennessee River Valley Authority. Those are all productive debt investments. And that would have been, that creates jobs, it creates economic activity. The debt pays for itself over time. You wouldn't have debt levels where you were. You'd have much stronger economic growth. But you and I are just, two old guys sitting around going, yeah, well, this this is the way we should have done it. But we're not the
All
ones
right.
running government, unfortunately.
All right. Well, let's take our old man energy and now trundle back into the markets. So I want to get back to my point
Sure.
earlier about how I don't think the situation has changed that you have been warning us about for a good while now, which is valuations are really stretched and earnings estimates seem unrealistic.
Mhm.
And so at some point, uh, market valuations are going to have to right size or at least correct a little bit to get closer to right size. Obviously, right now, market doesn't care today. So you just recently wrote a piece called "The U.S. Economy: Recent Data Suggests Risk to Earnings." So what's your latest on sort of where earnings are and the risk of correction? Again, we're talking risk of correction,
Yeah.
5, 10, 15%. We're not talking 50+%.
Yeah. So, the problem is that if you take a look at forward earnings estimates right now, you can draw an exponential trend line for earnings going all the way back to 1900. And we are more deviated above that exponential growth trend line than ever in history. And this is forward estimates going into 2026, which means that ultimately we're expecting earnings to grow at a faster rate than the economy can actually generate. Now, here's a very important takeaway from this conversation. Economic activity is what creates the revenue for companies. So when you and I go out and we buy something, we transact a transaction, we go to a store, we buy a pair of jeans, and those jeans create revenue for the company. The company then subtracts their cost of goods sold, et cetera, their expenses, payroll, salaries, all that. That gets you down to earnings at the bottom line. You then multiply the number of shares outstanding. That's how you get earnings per share. But if you don't have the economic growth, you don't have the revenue at the top line. And so if you take a look at GDP versus personal consumption expenditures, which is what makes up 70% of GDP calculation, they have an extremely high correlation, as they should. There's also, from that, a very high correlation between the annual rate of change in earnings and personal consumption expenditures, which makes complete sense because that's the money we're spending in the economy.
Mm-hmm.
So if PCE is slowing down, that means that transactions for revenue are going to slow down, which means that earnings will eventually have to be brought down. Earnings estimates will have to come down to meet with what's actually going on the bottom line. Now, there is a big gap right now between the revenue at the top line and earnings at the bottom line because of accounting gimmicks. This is one of the issues that hit CoreWeave earlier this week. Also, the buyback issue reduces the number of shares outstanding, which manipulates the EPS at the bottom. So there's a lot of things that go on that manufacture higher rates of EPS versus revenue growth. And this is why it's always important to watch what's happening with sales at the top line as to really understanding the health of a company that you're investing in. Are they actually growing revenue or are they not? Because if they're not growing revenue, but they're growing earnings per share, go take a look at how many buybacks they're doing. And if the number of shares outstanding are dropping like a rock, that tells you what's going on. Eventually, that revenue growth will matter. And if they're not growing
Apple.
revenues, it's going to
Apple.
matter.
Oh, sorry.
Yeah.
I got a little
Yeah.
cough here.
Well, they actually grew revenue in the last report for the first time in like 5 years. So kudos to them. But yeah, those are the things to pay attention to. And again, estimates right now in the markets are very high because that's how Wall Street justifies their price targets. If I want you to buy stocks, if I want you to buy Palantir or CoreWeave or whatever company is I'm promoting through my firm. So Goldman Sachs, I'm Goldman Sachs right now, and I'm doing an underwriting for the new shares of CoreWeave. They're coming to market. I'm going to give you these really rosy, optimistic projections about how great this company is going to be, and we have these decades long of revenue growth. Because if I told you that, hey, this company is coming out at a massive premium to earnings, and we don't know if they're actually going to be able to grow into that or not, you're not going to buy the shares, right? So they can't offload those shares. So this is why estimates are always optimistic. Estimates are always elevated, as particularly at the beginning of a quarter for the next quarter, and then they revise them down very quietly in the background because nobody's paying attention to them. But that's why we always get much lower estimates by the time we get to the end of a quarter.
So let me just clarify one thing on that, because
Sure.
someone will hear that and say, well, if they guide me to a big number and then they start walking that number down, then how come the stock price isn't adjusting? And it's because they'll say, look, a year out, 12 months from now, we think we're going to have these amazing earnings, right? A quarter later, they say, well, actually, now that it's 9 months away, those earnings aren't as good as we thought they were going to be, so we're ratcheting those down. But 12 months from now, man, that number is going to be awesome, right? And they just kind of keep pushing that.
They keep rolling it out there. Yeah,
Yeah.
exactly. So again, it's just really important to pay attention to kind of what's going on. And if you take a look at the economy itself, that's just not growing that fast. Here's a chart of, so this is the ISM Composite Services Index. Whoops. I want to share these two charts with you. So this is the ISM Composite Index. So this is ISM Services and ISM Manufacturing, and they're economically weighted for the economy. So 70% services, 30% manufacturing, because that's how our economy is currently weighted, give or take. What you'll notice is that the economy on a weighted basis is barely treading expansionary territory. I mean, we're just kind of hugging along these lines. And if you go back kind of in history, whenever we were at these levels, we were having the Japan shutdown, debt downgrade. We had the Euro crisis, Brexit. You had the pandemic, financial crisis, invasion of Iraq.com, long-term capital. When you're normally at these points in the economy where the economy is just barely chugging along, estimates are coming down, the markets are struggling. There's worries about a recession, but we're ignoring all of that right now because we have such booming earnings. Earnings are absolutely just booming. If you take a look at the last earnings for quarter two, 85% of companies beat estimates. The earnings grew by like 9% on an annualized basis. So everybody's like, "Oh, this is great." Problem is that all those earnings are coming out of two sectors: the mega cap and tech sector and the financials. Outside of that, there was no earnings growth. If you took those two sectors out of the economy, the markets and the economy actually had negative earnings growth over the last quarter, which would look more like kind of what's going on economically in the economy.
Right.
But you
So,
just
sorry,
have this.
let me just clarify something you said.
Right?
So you said all the earnings growth is pretty much just in a couple sectors, right?
It's basically about 10 stocks. It's pretty much, I'd say close to 20 stocks. It's the major banks. It's JP Morgan, Goldman Sachs, Bank of America, Wells Fargo. And then it's
And the
NVIDIA,
hyperscalers.
Palantir,
Yeah.
Microsoft, Google, Meta. That's
Okay.
it.
So all the earnings growth is in 20 companies. You also said 85% of companies beat their earnings expectations. I just want to, that might sound contradictory to folks, but you could have projected negative earnings that were better, that were less negative than you expected.
Right.
So that is an earnings beat, even though it is still a loss, not actual positive
Right.
earnings.
Or it was when they say earnings beat, they say, okay, but I'm just making up an example. But let's say that last quarter, a company earned $1.25 a share. This quarter, they earned $1.23 a share, right? So they earned less than they did last quarter, but the estimate was they were going to earn $1.15 a share. So they beat earnings. So, but that's the whole problem, is that going into each quarter, we lower these estimates down, lower, until they can find, and then that way we get a big bunch of companies that beat their estimates because we got the estimates below where the actual number should be.
Okay, so the earnings were actually declining, but it was still a beat.
It was still a beat.
Yeah.
And that's why, taking a look at beats is really not a good measure of the health of the overall market.
Okay, makes total sense to me. Again, I just wanted to square that up for people who might have been hung up on that economy.
Yeah.
Okay. Well, look, let's get to the rubber meeting the road here, Lance.
Mhm.
The average viewer is going to say, "All right, Lance, it makes sense to me. Like, when is this going to matter?"
I
And
don't, I don't know when it's going to matter,
I know you
unfortunately.
don't know, but with a declining economy, it does become a matter of time unless something changes that trajectory of growth, right? And I want to make one other point, and I'll let you
Sure.
build on this. But something that you've said is look, uh, a lot of the factors that many macro folks were worried about over the past 2 years, they didn't matter as much because we were still coming down from such
Mhm.
a high degree of economic growth when we spurred the economy through all the stimulus from COVID and whatnot. Um, but now that we are, basically through all that, we're now basically just flying just a little bit over the horizon or over the ground at this point. And so dips in the economy now have the potential to do much more damage or to be much more felt in the economy because we're so much closer to the zero bound at this point. True?
True, but it doesn't matter. And this is the I don't want to say it's a bad thing because that's not the word I'm looking for. But look, we've changed the market dynamic, particularly in the last 5 years, ever since really 2020, when we sent checks to households, we turned and Robinhood came online. We've turned the markets into this whole casino thing. Here's a chart of this is what's actually kind of stunning when you think about this. This is a chart of ETF flows, and you and I talked about this whole market. So this is a very important factor. And when you talk about valuations and you talk about, the detachment of earnings from fundamental reality, et cetera, that doesn't matter. In the short term, it doesn't matter because we have so many people now just throwing money. That top line that's just going 45-degree horizontal,
Yeah.
vertical, that's retail ETF purchases. So retail investors are just throwing money into the market. We have now convinced them that the easiest way to wealth is through the stock market. In fact, there was John Penn and I. We do this show on Tuesdays called Two Dads on Money, and we kind of just talk about how we manage money for teach our kids to manage money, hope to try to help other parents with their kids. And we reviewed recently this article that was out. They did this survey of people under the age of 35, and they said, okay, when do you want to retire? And the vast majority of responses, I want to retire by the time I'm 35, but I'm not going to get there through saving through my job. The only way I'm going to get there is by investing in the stock market. And so this is what you see is that you see this whole dynamic of people that really didn't even come to the market until 2020 now seeing that, so I'm buying Bitcoin, I'm buying, ETFs. And of course, we talked about the whole function of ETFs that just funnels money into the top 10 stocks of the market. Those 10 top 10 stocks keep going up. That drags the whole market up with them. Their earnings are being generated by all these people now online, buying ads and buying stuff offline. That's just, seeing massive growth in ad revenue for companies like Meta and Google and everything else. So it's just a self-filling cycle right now. And that's just kind of distorting the whole market. And the more money that we pile into ETFs, the more it distorts the market because it's just funneling 40 cents of every dollar, about 38 cents of every dollar into 10 stocks. And that just keeps lifting the whole market up, which then the market goes up, we get all excited. So we keep buying more of the ETF because it keeps going up and you see where this goes, right? Now, what eventually reverses that? Well, at some point, you've got to get people to sell those ETFs. And I don't know what causes that. I don't have any idea. But something's got to happen in this market that people start to question their ability to get rich by investing in the markets and they start selling their ETFs.
Okay. Well, so as I'm looking at this chart, Lance, we've got the light blue line up in the top, which
Mhm.
is the individual investor ETF flows that are taken off, as you were talking about. But we have the darker blue line at the bottom, which is the professional investors ETF flows, or more appropriately, outflows. So
Okay.
is this an example of the smart money leaving out the back door, selling everything it can to the patsy coming in at the end?
Well, you say that, but lately, really over the past 5 years, professionals have been selling this market. Retail investors are buying the dip, and retail investors are making the money. So are retail investors now the smart money is the question, because they're buying every dip on the expectation that the Fed's going to bail them out, somebody's going to bail them out, and they've been right every time. In April, good example, right? Everybody's all concerned about tariffs. Professionals out there selling the market because tariffs are going to destroy the economy. They're going to create all this inflation. Retail investors were buying that dip the whole way down. They were right. None of the stuff that professionals were worried about came to pass.
Okay.
So
Um,
I'm just kind of stating the obvious, but we got to
yeah.
start. We need to start questioning who the smart money is now.
But so, okay. Look, I don't believe that you believe the retail money is the smart money here. I believe you think things have worked out their way. But let me ask you this then. So to me, I kind of look at that and I get more worried than just a regular correction, right?
Yeah,
Like,
you should.
yeah. Okay. So, all
Because
right.
it's not,
That's
look,
going to be my follow-up question.
at some point, Adam, and again, I don't know what causes it, but at some point, something will happen. It will be unexpected. It'll be exogenous. It'll be nothing that we're talking about today, or you can fathom right now. Something will happen that causes people to question Bitcoin, causes people to question stocks, and that starts the outflows. This chart right here, this is the earnings per share of the Magnificent Seven versus the other 493 shares of the company, of the index. That is not sustainable. You cannot have an index trading at 25 times earnings with only seven companies driving the earnings.
Hmm.
It just doesn't make sense. But in periods of exuberance, where people throw caution to the wind, I'm buying call options out the wazoo. I'm not hedging my portfolio. I'm not buying. Who wants puts? This market's never going down. This can last for a long time. And this could last weeks, months, years. Who
Yeah.
knows?
And speaking to your point of who wants puts, I think the put to call ratio is back to plumbing. It's near its all-time lows right now.
Yep, absolutely. Sentiment's getting very optimistic again. We take a look at sentiment indexes, we take a look at positioning indexes. Those are getting very bullish again. Technicals are getting very stretched. Although this kind of recent correction we had this week relieve those a little bit, but they'll be back up to all-time highs next week if this rally continues.
Okay. So just a reminder to folks, the best time to buy insurance is when you don't need it, and ideally when it's on sale.
And when
So
nobody wants it.
yeah. So, maybe not a bad idea to consider just adding some, longer term put options to your portfolio here if you're
Yeah.
experienced hedging with puts. Or if not, talk to your financial advisors about what affordable hedges might make sense right now given your current portfolio allocation. Okay, so let's see here. Okay, so Powell is talking about, apparently today, talked about the integrity of the employment market and maybe indicating that he's starting to get a little bit more nervous about it than he has been, which I think is kind of interesting, Lance, because all year when he's done his press conferences, the media corps, which generally treats him with kid gloves, has, I think, voiced some, you know, some, they've said, Powell, you're saying, Chair Powell, you're saying everything's just fine, but we're hearing these stories about the jobs market maybe not being as robust as it seems. And Powell really kept trying to dance around like, no, it's not getting worse. It's just normalizing. This is all good. It sounds like maybe he's finally beginning to not be able to dance around that as much as he has in the past. So obviously where the employment market goes is critical. Where unemployment goes, the economy goes, right? But another big factor around people's sense of personal financial well-being and ability to spend is housing, right? And I've done a couple of interviews this week with housing experts, one of which is released already. The other one's going to release the day after this video airs. The first one was with Ivy Zellman. The second one was with Melody Wright. Ivy is, she's much more sort of establishment. She's a very popularly followed housing analyst. She has a lot of corporate clients and whatnot. And honestly, Ivy hasn't said this. This is my interpretation. It's harder for her to be bearish publicly because she has a lot of paying clients and because there's a lot of mainstream media that kind of hangs on what she says. That said, she believes that a housing correction is in play, and we will see a drop in national housing prices in 2025 by the end of this year. Now, she thinks it's we're probably seeing the worst of it right now, and in her words, we'll be grinding along the bottom for a year or so. But she thinks the healing is slowly starting. Um, I'd be interested to see her debate with Melody Wright, because Melody thinks that we are at the start of a multi-year housing correction here. But my point here, Lance, is you've got analysts on different parts of the housing spectrum saying things are going to get worse before they get better here. It's just a degree of how much worse they get. How big of an impact do you think that's going to have? Like when you say things that make people start to slow their roll in terms of their level of speculation, would a material enough housing correction get enough retail investors to say, you know what, I got to start playing it safer here?
No. And the reason why well, let me back that. Let me say that up. It depends. It's not a no. It depends. If the housing correction happens literally overnight, like we had in 2008, where you had the mortgage industry just lock up and freeze, yeah, that's going to be a big problem. If this is something that just grinds along for 2 or 3 years, markets will adapt and it won't be a factor because everybody will just become aware of it. Now, what that will do is that's going to put a lot of downward pressure on inflation because housing makes up 40% of the CPI
Right.
calculation. So,
Right. Which is another thing in Hanke and yours
yeah,
camp there, which is the
right,
biggest factor is disinflating right now.
exactly.
Well,
And
it's actually deflating right now in a lot of markets. Yeah.
exactly. And so, but yeah, when you look at the housing market, there are a couple of interesting things going on. And this is, everybody's hanging. So I talk to a lot. I have a lot of real estate clients that I do hard money loans with. I have a lot of contacts in the real estate industry, and they are all like this for Fed rate cuts because it's the Fed cuts rates that incre that helps boost the whole value of the underlying real estate project. Um, because you start having cap rates improve, everything else gets better.
Yeah, your discount rate gets lower. Yeah.
Exactly, lower discount rates, easier for people to get financing for deals. A lot of these real estate deals that are getting built right now are all hinged on lower rates to refinance, 2 or 3 years from now, so they can refinance all their investors out of it. So everybody's hanging on to this, and so the question though becomes, what market are we talking about? Because if we're talking about the new home market, that's one thing. If we're talking about the existing home market, that's another thing. Because for the first time on record, existing homes actually cost more than a new home because a lot of people are sitting on their houses because they can't sell their house and then go buy another house because the mortgage rates are too high. They've got a
Right.
2% mortgage. They don't want to go get a 7. So we've got a lot of potentially pin up sales. We talked about this before that maybe one of the surprises is rates come down and we have a big drop in housing prices because so much supply hits the market. I don't know if that's the case or not, but
Yeah.
that could be a
I,
surprise that nobody's thinking about.
I think it shouldn't be dismissed. And also just one other thing too, which is, I mean, both Ivy and Melody think this, which is the builders are showing us the way of the future. They
Mhm.
are doing mortgage buy downs, price concessions, and other non-price concessions to move these homes, right? So it's basically just showing that, like, look, what clears inventory is lower prices.
Yep. Well, and again, then the other side of this is maybe rates come down and we get this massive surge in the developers go, okay, rates are down. Let's go. We've been holding back on building, new multifamilies or new housing divisions or whatever. Maybe they come to market and just start building a lot of supply and we have a big jump in supply that we're a bit short. Right now we have a shortage of supply. We've got about 8 last time I checked, it was around 8 months of supply right now to get into markets. All of a sudden you get a big jump in supply that depresses pricing more. So my point is that I think there's a lot of unanticipated consequences coming to the housing market that maybe we're not all kind of thinking the way through. Because right now, it seems to me most everybody I talk to in the real estate market, they're just crossing their fingers for cuts because this is going to just cause their business to boom. And maybe they're right. But I just think maybe there's a risk out there that doesn't come to fruition like everybody thinks.
Yeah. I hate to speak for other analysts, but I think Melody would say I'd be very cautious if that's your strategy here. Um, Last point, and then we'll get to your trades, Lance. Melody said something really interesting. So for years, when I interview housing experts, now I have bandied about the intellectual exercise of we've got all these baby boomers, what's going to, is the last of them are still hitting retirement age, at the rate of 10,000 a day, right? But the older cohort is getting closer to the day where 10,000 of them are going to be aging out, right? Meaning either going to the nursing home or dying, right? And so the intellectual question I've asked them to expound on is what is that going to do for the housing market? Is it going to place a multi-decadal headwind on housing because you're just going to have this relentless inventory coming on, day by day for
Mhm.
20 years, right? And in most cases, those homes get sold, right? You got multiple kids, the kids start fighting about who gets the house, and they're just like, you know what, let's just sell it, right? We'll sell it and split the
Yeah.
money, right? Um, so I would say in general, everyone I've talked to has said that, yeah, that is going to be a real demographic trend here in housing. It's going to change housing for a prolonged period of time. You're going to have this just, unstoppable headwind. Um,
Which could be a good thing.
Oh, it could would be a great thing for affordability for you, right? I
Yeah.
mean, it'll be a bad thing, as we've talked about, for those boomers who are expecting to sell their homes for a certain price, where you may be able to sell your home in the future, but there may not be demand anywhere near what you're currently hoping you're going to
Right.
get for it. But the important thing was talking to Ivy. She was like, "Yeah." I asked her about it this time, and she was like, "Yeah, I still think that's going to happen, and it's coming soon." And I said, "Well, when it does, let's sit down and talk about it in real time." Talking to Melody, she says she's seeing signs it's already started.
Mhm.
And I think that's really interesting that
That's
we're going from the academic to the real.
Yeah. No, I've seen some data lately that, look, I'm not I do enough real estate analysis for my hard money business, so I understand what's going on that standpoint. But no, I've seen some data lately that kind of supports Melanie's point that, that slowdown is occurring, and we're starting to see, houses sit on markets longer, those type of things as well. So, I don't think it was interesting. There's this company here in Houston. They um, have been running. They do like educational classes and seminars and stuff like that for multifamily housing. And they recently just quit advertising with one of the radio stations here in town because the lead flow has slowed down dramatically.
Yep.
And I think that's just a function of kind of really what's happening in the overall markets. We're starting to see, a lot of those opportunity zone deals. When Trump was first in office, he created this tax break called opportunity zones, and we saw all these people run out and build opportunity zones. And we had a lot of clients coming to us going, "Hey, we want to invest in opportunity zones. What do you think?" I'm like, I would be very careful with that because you're getting a whole bunch of properties built in areas that, are not great. And these projections are really optimistic. And if rates go up for any reason whatsoever, you're going to be screwed.
Yeah.
And it's exactly what happened. And a lot of these people now, they were looking for deals where they could be out of them in 3 years. They're locked up in them for a decade or more, maybe, before they actually get out of these things. So, again, this is why, if you're going to do private equity investing, real estate investing, whatever, make sure you want to really understand how to do your analysis because, all these optimistic projections are always extra rosy going into these to get you to invest. You got to really think about, okay, well, let's stress test these things. What happens if rates go to here, or if this happens? What happens to my investment? And a lot of times you'll figure out that there's a lot more risk in these than you think.
All right. Well, look, I'm sure that the real estate is going to give us a lot to talk about
Right.
going forward here. So we'll pick up this baton again in the future as need be. All right. As we begin to wrap up here, Lance, trades. What trades have you guys at RAA made over the past week?
None this week, none this past week. Previously we added healthcare, we trimmed back tech about 3 weeks ago. We were a tad early, but that's worked out very well for us. Portfolio is doing really well this year, holding up well against the market. The interesting ones that I've really been fascinated in is all these thematic models over the last, 2.5 weeks, actually 3 weeks now, because just to watch that there's so much information in those telling you where money is rotating in the markets, and you can just see. like the all-weather portfolio, which has gold and precious metals and those type of things, it's done okay, but small mid caps are crushing it by about 100%. So,
Wow. And so,
just in 3 weeks.
when you talk about these thematic models, you're talking about the new models that you
Yeah.
released on Simplevisor that we walked through last week, right?
Yeah, exactly. So,
Yeah.
and you can kind of see them here. But basically, you take a look at all weather. It's just, again, this was just 2.5 weeks ago. The all weather portfolio, which is gold, silver, has some dividend yielding stocks in it. It's very boring. It's up about 2.5%. Small and mid caps up 4.1%.
Yeah.
So it's been, but interestingly enough, we have what's called an accumulator model.
And I love how that's crushing it. Yeah.
Yeah. Now the accumulator model it's just five ETFs basically. It's real estate, international, emerging markets, S&P, and Nasdaq, and it's up 4.86% over the last 2.5, 3 weeks, and keeping pace with small and mid caps. But you dig into that portfolio. This is for people just getting started out. So you got like $5,000. You just want to get invested in a portfolio, whatever. This is kind of a good place to start because you can just kind of start building this model and then start kind of just adding to it. But that is really a function of your when you dig down to that, you're seeing that it's international, it's emerging markets. Those are really outpacing the overall market. So when we saw that rotation to defense last week, we saw money rotate into more defensive areas like real estate. That really helped that portfolio outperform. It's up 2% today because the market's up 2. But small mid caps and crypto are crushing it today. They're up 3.5% each. So it's just interesting, like I said, to watch the factors of the markets kind of because that's what these are really representative of, because it kind of tells you where it's risk on or risk off.
Yeah. Well, and this Simplevisor is great for a whole bunch of different types of people, and we talked about it last time around. But it is really great for people that are just starting out who, to your point, Lance, they just need to accumulate so that they can get up to the point where they can graduate to a full service relationship with an advisor like you, where they can start getting really customized strategies implemented. When it's great, you've got that accumulator model that gives them good diversification, and they can just, benefit from that over the course of their accumulation phase. But Simplevisor also lets them look like, I know you've said, before you build a car, just get in a car and drive around and get a sense for how the car works, right? So you've always said like, yeah, just get in the market and just watch the market before you start getting real sophisticated with individual trades. Just understand how the market works, what it does when certain things happen, what it doesn't do when other things happen. And what's cool about all those other models you have there is they give you a better sense of kind of the heartbeat of the model. Oh, given what's going on right now, yeah, everything's going into small caps or everything's going into the high tech, high beta companies or whatever, right? So
Exactly.
it's very good for as you're accumulating to just sort of get that exposure to how the markets generally function. So by the time you're getting to the point where you're starting to be more specific about I want specific exposure to X, Y, or Z, you have a good sense for how that asset sector, class, or sector responds.
Exactly. And then again, that's why we look, and again, that's why, like last week, we were going through the sector rotation, looking at what sectors are out of favor versus in favor. It just gives you a lot of information about, because money doesn't leave the market, it just rotates where it is. So over the last week or so, the high dividend model and the accumulator model did really well because those are more and the all weather model, which are more defensive, did really well. Today they're not doing so much because the money's coming out of that to go back into the risk on model. So it just, watching these rotations can teach you a lot about, not only where to invest in the markets, but when to take profits, how to rebalance, when to rotate between momentum and value, those type of things, because those can help you really outperform over time. We get all wrapped up into one thing. We're all momentum. That's great until momentum stops working. And if momentum stops working in your portfolio, where's the money in your portfolio going to go? Is it going to go somewhere else in your portfolio? Or is it going to leave your portfolio and go to somebody else's? And that's
Right.
why it's really important to understand and have a balance of these things within your overall financial structure.
Okay. All right. Well, look, let's get to the rant and then we'll wrap things up here. Um, you know, Last week for sure, but often on this channel, Lance, we talk about you know, dealing with adversity and the fact that culturally we have become less resilient, right? We talked a lot about
Mhm.
Greg Lukianoff and the coddling of the American mind. We talked about how, more often than not, people are want to adopt a victim mentality rather than just take control, of their lives and solve their own problems. We've certainly seen that kind of been sold to younger generations. It's victims and oppressors, right? Um, so today I was trying to see if we could maybe talk on the other side of things, right? On the more
Okay.
positive side of things.
There's no positive.
And
It's all doom and gloom.
well, yeah, but also just like, so what's the inverse of that, right? And the word I kept coming to was grace. Um,
Mhm.
Living life, dealing with adversity, with, grace and, you know, positivity, but, the ability just to not wallow in self-despair, right? I've always, I'm generally a pretty like non-emotional guy, but the topics that I have the most emotional resonance with is when I see somebody really performing with grace under pressure. So I want to tell a quick story, and then we'll hand the baton to you. Um, I mean, this really was terrible. I remember this is probably like getting close to 20 years ago. Actually, it was more than 20 years ago. No, no, I'm sorry. It wasn't that long ago. It was I don't know, 10 years ago. Um, we were visiting my in-laws and they had the newspaper on the table. And on the cover of the newspaper was a terrible, tragic story about a family that was camping in Yosemite. And they were right there in like the main camping area. So they weren't, totally off in the national park on their own. Uh, and the son was with a friend. So these are teenage boys, probably 15, 16. And they were sleeping in their own tent. And a branch from one of the giant redwoods there broke off and landed on their tent and killed the boys. Just a terrible development. And the article talked about it was written by somebody who was there, and they talked about how the morning stillness was pierced by a woman's scream. Who it was the mother waking up and realizing what had happened to her son and his friend. Just a terrible, heartbreaking story. Um, so later on, within a week or so, I learned that the woman who screamed, the mother, was a good friend of mine from business school. And just a terrible, terrible loss. As these stories go, this young man was top of his class, bright, shiny kid, accomplished musician, beloved by everybody, star athlete, just the whole package, right? It's how these stories go. And of course, devastating to my friend and her husband and their daughter, and just broke her the way that you would imagine this would. But she, persevered through it all, and has become somebody who speaks very openly about it, but doesn't wear the grief like a permanent veil, over her body. She uses it as a way to process how she's feeling in any given moment, but really to show others that there's a way through devastating loss and big life challenges, and that there is an other side to get to. You're forever changed by tragedies like that, but they don't have to define your entire identity, and they don't have to permanently break you. And so she's ended up, really helping people deal with loss as a result of that. It's not what she does for a living. She has a regular job, but she is very involved in helping people who have had terrible things happen to them learn how to get through them. So, anyways, she is a great example of persevering with grace. And what's great about this is her name is Grace. Um, So, anyways, wonderful person. Where I'm going with this is, my wife is a couples therapist, and she has a lot of clients who are very successful, a lot from Silicon Valley. And what I've learned from the sidelines watching her do her work is that, no matter how great anybody's life looks, Lance, everybody has their own stuff that they're going through, their own trials and tribulations. And it's really at the end of the day, the choice that you make. Am I gonna make myself a victim out of this? Am I just gonna rat hole in how much life sucks and talk about all the things I wish were different, but how the universe hates me or the system is broken or bad or whatever? Or am I just gonna, deal with it however it is and just find a way to get to a better place here and kind of, become the hero in my own story, even if the process may suck, right? I'm just gonna not let it define me. I'm not gonna let it steal my agency, and I'm just going to find a way through this to a better point. So I'll wrap it up here, but my advice here to folks is, recognize and practice grace more actively in your life, whether it's with the challenges that you're going through, or whether it's, recognizing those who are dealing with trying times, but doing so with grace, right? Not letting their problems become everybody else's problem, or not just spinning in despair. We need more of those people. We need more of that grace in life, and we'll get it by practicing it. And I'll end by noting, Lance, I know you and your family are going through a bit of a challenging time right now, and yet, you're here doing this interview. You're not letting on that you've got other balls that you're juggling in your life. You're doing a good job of being an example of grace right now.
Yeah. Yeah. When you were going through this, I was like, this is hitting a little bit too close to home right now. So I don't really have a lot to say right now on it because I don't want to break down. But um, yeah, just, and this does bring up, a lot of the stuff that we talk about here from time to time, especially for the younger generation. And a lot of times, we'll talk about topics, and then I'll get, oh, he's just an old boomer. He doesn't understand. He doesn't understand our plight because he's an old boomer. And I'm not a boomer. I'm Gen X, but same thing.
Yeah, you're old Gen X, but you're Gen X.
Exactly. Right on the cusp. Um, but the point is that, you know, we can all just curl up in a ball and go hide in the closet and hope it'll go away. Or you can just kind of pick things up and say, okay, recognize what the problem is, come up with a plan to fix it, and then move forward. One of the greatest pieces of advice. So I told you before, I have this mentor. One of the, and it's always funny when people talk about success. They go, "Oh, look how successful that guy is. He's an overnight success." Well, it only took 10 years to get there, but just like Adam, overnight success took him a while to get here. But you go through when you're doing
54-year overnight success. Yeah.
exactly, right? So you're trying to go through, when you're trying to build anything, you're going to go through a lot of challenges, a lot of hurdles, a lot of disappointment. Things aren't going to work the way you think, and you're going to have to start over a lot. But eventually you're going to get there, right? But you got to stay to it. And so the easiest thing for us to do is just to quit. It's like, okay, well, I can't afford a house because everybody tells me I can't afford a house. Now, you haven't really done the work to figure out if you can afford it. You just assume that you can't because that's what you hear in the media. Everywhere in the media, it's like housing unaffordability. You can't afford a house. Yeah, that's using some means and some statistics and a lot of assumptions, but real estate's very different everywhere you go. It's different in California, it's different in Texas, different in Wyoming. It's just everywhere. So when you hear these media headlines that tell you can't do something, ignore it. You can do whatever you want. Now, it may be a challenge. It may require a lot of hard work. It's going to require discipline. It's going to require getting up and slaying. I tell my wife every morning I get up, it's like, okay, honey, I'm off to slay some dragons today.
Yep.
And she does the same thing. And every day we're pushing forward together. And right now, like Adam mentioned, we're in a very, very tough spot. But we woke up this morning and said, okay, this is our challenge. This is what we've got to get through. And, we're praying a lot and we're just figuring out, okay, it's not how to get to the end goal. It's how do we get to tomorrow? And if we get through today till tomorrow, then we'll figure out how to get to the next day from tomorrow. And we're just taking it one step at a time right now until we can see clarity as to how do we get to the end of this road of wherever this turns out, good, bad, or worse, and we'll deal with it. But that's, for a lot of people though, they just quit and they just say, okay, well, this is too big, it's too daunting. I'm told I can't afford a house, so I'm not even going to try to save money to buy a house, right? I'm just using that as an example, but it's
Right.
everything, right? I
But
can't
yeah,
go start a business because everybody says I can't start a business. I can't build wealth because, everybody tells me I can't build wealth, whatever. Pick what it is. And then one of the, like I said, I was going back to my mentor, one of the things he told me is that whenever you have a problem or a challenge in life, there's certain things that you can't do anything about today. I can't do anything about the situation that I'm dealing with right now. So I take that, I put it in a box, I'm going to put it up on a shelf here for right now because I can't do anything about it today. I'm going to focus on the things I can control. I'm going to show up here for Adam. I'm going to continue to run my business. And I'm going to continue to do the things I need to do that I can control because that gives me a sense of control about what I have in life. At some point, there's going to be a solution that presents itself for that problem that's on the shelf. And I have like 10 problems on my shelf right now.
mhm.
So, you know, and as a solution presents itself, I go take that box off the shelf, I deal with it. But if I just sit around and worry all day about those boxes on the shelf, and wallow in the idea that I just can't solve that problem, it just ruins me. I get nothing else done. And I make no progress on any other front because I'm so tied up into this one problem, this one singular problem I can't solve right now. I'm so tied up into that I can't do anything else. So he told me that piece of advice, and it was one of the greatest mental changes that I ever implemented, which was I'm not ignoring the problem. I know the problem's there. I just can't do anything about it. But instead of focusing on that, I'm focusing my efforts on the things I can control. And that gives me control, which is the one thing that we're always wanting in life. We just need control of our outcomes. Our worst despair and our worst depression comes when we allow the uncontrollable to take over for everything else in our life.
Yeah. Well, look, very well said, my friend. And yeah, you know, I hate to pull this slogan because I hate lotteries, right? But it's the you can't win if you don't play, or the Michael Jordan or whoever said it, you miss 100% of the shots you don't take, right? The people that give up, right? That just capitulate, like you said, Lance, you're guaranteeing the failure that you're ruining, right?
Right.
Where, if you want to have a better tomorrow, it is a matter of getting up, grabbing that sword and heading out to face that dragon, or just, putting the James Clear, the Atomic Habits, just start doing what you can. And to your mentor's point, yeah, today the doors might be closed to you to get to where you want to get to, but if you still put yourself out there every day, when one of them starts cracking open, you'll be in a position to start, forcing that door open the way that you want it to
Yep.
be. So, anyways, I wanted to inject some positivity into this discussion, even though we're talking about heavy things here. Is to your point, we will hear in the comments sometimes, "Oh, you're just a bunch of old boomers who don't get it," or "You guys are just doomers. You only want to talk about negative things," right?
Yep.
I think really recognizing and then emulating the things that we need more of in this world, and I think grace is right near the top of the list. It's something that's within all of our controls, and we are all dealing with challenges. I am absolutely sure that everybody watching this video, Lance, has
Mhm.
things in their lives that they're saying, I'm not sure how I'm going to get beyond this thing yet. And hopefully you take a little bit of faith, hope, and inspiration from us to just say, hey, look, just practice grace, just keep getting up and doing it. Keep calm, stay calm, and keep calm and carry on. That's the old
Yeah.
World War II one, right? So I'll end it there. But again, buddy, I just want to say you're doing a great job of practicing it right now.
Well, thank you. It's I don't know how I'm gonna get through this, but we'll get through it.
All right. Well, you will. And as we've talked about off camera, anything you need from me, I'm sure anything you need from this community as well, folks will step up. All right. Well, look, in beginning to wrap up here, then, folks. Very important announcement. If you didn't hear it already this week, the Thoughtful Money Fall Online Conference is now officially open for registration. The conference itself is going to be Saturday, October 18th. If you can't watch live, don't worry. Everybody who registers, just like all our past conferences, will get all of the presentations and all of the live Q&A, so you won't miss a beat. You can watch those replay videos, rewatch them to your heart's content. We've got a fantastic faculty. I won't go through it all right now because I went through it in a video that I just launched yesterday on the site. So you can go watch that video, get all the details, or you could just simply go to thoughtfulmoney.com/conference, get the details there, and you can register at the lowest early bird price discount. That's the lowest price we're going to offer for the conference. So I want to make sure as many people as possible get to lock in that lowest price. And as a reminder, if you are a premium subscriber to the Thoughtful Money Substack, go look at the email I sent you. You'll have a code from me there that you can use to get an additional $50 off of the conference. And just a quick reminder, if you don't subscribe to the premium Substack yet, it's only $19 a month. So if you want to game the system, sign up for a month, pay the $19 to save the $50 and pocket the $31 difference. Great, I'm happy. Take advantage of the system like that. I just want as many people as possible to get the lowest price as possible to attend and enjoy the conference. Going to be a very important conference this year, folks. A lot of uncertainty heading into 2026. So we've got the best minds in money in the markets there to tell you what they think is most likely to come. So as a reminder, run, do not walk, to register if you haven't already at thoughtfulmoney.com/conference. All right, and if you think one of the absolute best ways you can start practicing grace more in your life is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And as always, if you would like to get some help in figuring out how to navigate your financial wealth through what the future may hold in store for us, if you don't already have a great financial advisor who's guiding you through that, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com, and these firms will be in touch with you right away. Lance, my friend, another great week. As usual, I'll give you the last word here.
Well, I just think that if you're showing up here to listen to this every week, that's a lot of grace right there. So I'll take it.
Yeah, if you've made it all the way through the end of our long rants every week, that's exhibiting
That's a lot of grace. That's a lot of grace. I appreciate it very much, by the way. Thank you.
All right, my friend. Thanks so much. And everybody else, thanks so much for watching.
I think a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell, maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing, it's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%.
Silver is up 42% this year, outpacing gold and marking its strongest 5-year rally, fueled by industrial demand from solar, EVs, and electronics. HSBC raised its outlook, citing a growing supply deficit of 206 ounces in 2025. Analysts agree silver remains undervalued despite big gains, with momentum pointing to $44 to $48 by year-end. Mining stocks, especially juniors, are already outperforming, offering leveraged upside as investors rotate into the sector. David Morgan, widely known as the Silver Guru, is a seasoned precious metals analyst, author, and founder of the Morgan Report. He points out that silver's momentum is building thanks to institutional buying, industrial demand, and algorithm-driven trading that continues to push prices higher. Despite heavy short positions, the trend has turned positive, with momentum indicators signaling strength. Gold has already broken out, while silver, being a smaller market, tends to move more sharply once momentum takes hold. Historically, miners often led metals higher, but this cycle has been different. Metals surged first while miners lagged. Now, strong earnings and value recognition are finally fueling a rally in gold stocks. Silver stocks remain trickier since most companies are not pure silver plays, often producing other metals alongside it. Still, silver miners can command higher premiums in bull markets because of silver's volatility and popularity at the top. David recommends that traditional valuation metrics like PE aren't the best for miners, as free cash flow and balance sheet strength matter more. According to the Morgan Report, well-positioned mining equities, starting with blue-chip producers and selectively adding speculative plays, offer some of the best leverage in the resource sector, especially as demand for metals like copper, lithium, and rare earths accelerates. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
As I've said before, and it sounds trite, but it is true, and that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is, but we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum, and momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts. It's I've been in this market more than 40 years, and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip-off for somebody that's, studied these markets. Like, these gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated, a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies, because many of these companies are trading as if gold is at 2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And wherever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing, that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays. If any, there's really one silver stock I can think of that's more or less pure silver play. The rest are silver plays, but they have, lead or zinc or copper or gold or something, combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but an equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
I'm not finding it in the comps table. I was curious where we're at in terms of valuations for the major miners, but also some of the smaller producers. Like, where do you think we're at right now? Do you have an overview?
I don't. I know we're below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk to reward profile.
David mentions that in Elliott wave theory, the third wave is usually the strongest and most dynamic, marked by the sharpest price gains in the shortest time with heavy trading volume. This stage reflects a major shift in psychology, moving from disbelief to broad recognition as more participants enter the market. Currently, silver seems to be in the early part of this leg, with institutional and industrial demand driving momentum while retail investors remain hesitant, especially those who only recently broke even. Asian markets are also playing a larger role than before, though retail silver buying there still lags behind gold. Looking ahead, this leg could bring the most powerful price appreciation yet, potentially lasting several more years. While past rallies, like the false start in 2016, failed to sustain momentum, the current setup appears stronger, supported by gold's breakout well above $2,000 and holding near $3,500. David predicts that the coming days will confirm whether this is a genuine breakout or another fake-out, but the fundamentals and market psychology suggest silver could now be entering its most explosive phase. Let's move into the interview.
That wave 3 up, there's 5 waves in Elliott, is usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. It's driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. But institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But the facts are backing me up now. There was a false start, I believe, in 2016. I can, talk about that. I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2000 breakout level. It's $1,013, $1,400, $1,500 above that. Almost not quite a double, but from 2000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times.
Silver appears to be entering a decisive stage where strong momentum, institutional demand, and shifting market psychology could fuel its most powerful rally in decades. With gold already sustaining record highs and miners beginning to catch up, silver's smaller market size and volatility suggest sharp moves ahead. Whether this proves to be the beginning of a lasting breakout or another temporary surge, the conditions look stronger than they have in years. Do you think silver can outperform gold in the next phase of this bull market? Will retail investors return in time to catch the biggest gains, or will institutions dominate this rally? We would be glad to hear your opinions, so please leave them in the comments area below. If you found this video useful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.
That we're still at above 2.5%, close to 3% in the US inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon. And this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980. But far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the Endgame Investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the videos so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that. Once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price. But this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension. And then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate, and you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate, and the interest rate has been being cut since 2024. And you can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up. Blah, 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 blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up because the US inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising, they were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, but we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the US inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing. And it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
We're moving into a new digital system. I believe that this will now usher in the hyperinflation to burn off the debt that's being created. So we'll have Amazon stable coins and Walmart stable coins and Kmart stable coins and, JC Penney, as well as JP Morgan, as well as Hong Kong stable coins, the yuan stable coins. So it is an extraordinarily fragmented market, but they are thinking that within the next 2.5 years, by 2028, they will go from about 125 billion stable coins to $2 trillion in stable coins.
Stablecoin adoption is accelerating, with issuance doubling to $250 billion from $120 billion. Offering a more tempered outlook, JP Morgan estimates the market may reach $500 billion by 2028. Meanwhile, forecasts suggest the market could grow to $400 billion by year-end and $2 trillion by 2028, citing limited mainstream adoption and regulatory challenges. Yet, only 6% of usage is tied to real-world payments, while most remains in trading and DeFi. The Genius Act is shaping regulatory clarity, boosting institutional interest as major players like JP Morgan, Amazon, and Walmart explore stablecoin models. Analysts see them becoming core payment infrastructure, bridging fiat and digital money in a hybrid financial system. The speaker, Lynette, the chief market analyst at IDM Trading, argues that silver and gold are massively undervalued compared to their true historical ratios and fundamental worth. Based on a traditional 20-to-1 gold to silver ratio, silver could be valued between $1,300 and $2,000 per ounce, while gold's fair value could range from $33,000 to $40,000. Current spot prices are seen as artificially suppressed by paper derivatives, but since both metals are sound money, they cannot be inflated away like fiat currencies. In times of crisis, gold and silver act as a bridge, preserving purchasing power as overvalued fiat-based assets, and real estate collapse, enabling wealth transfer to those holding real money. Looking ahead, Lynette warns of inevitable hyperinflation as currencies lose credibility. In such scenarios, governments historically revalue gold to restore public trust, often after lopping zeros off collapsing currencies. While gold and silver prices would soar during hyperinflation, gold has historically held elevated value longer than other assets before being adjusted, only to climb again under the new system. This pattern, repeated throughout history, is expected to play out again. As we present clips from the video, firstly, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
What happened in 1980 at that $50 mark, I consider this a massive double cup because it did come up to breach that level. And so when it goes above that 50, would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce, and that's just based on the 20th to 1 that historically we were. These were both, well, it's a peace dollar. Okay. These are both $1, little $1 gold coin and a silver dollar. So that's a 20-to-1 ratio right there. So according to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,300 and $2,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. But gold and silver are sound money. Sound money is money that governments and central banks cannot inflate away. They can manipulate what you see through the use of garbage derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms. But what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system, and dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money because it is a tangible as well, but it's severely overvalued. That's going to flip flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Well, I personally do not see it. I see it as inevitable because what gold really does is it regains confidence. I mean, they want us to think that gold is an old relic, except wedding rings are generally in gold. You know, good as gold. It's in our vernacular. It's in our DNA. And it's used to regain public confidence after that massive failure, which I believe we are like this close to experiencing, and the hyperinflation. But make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history because this has happened over 4,800 times. I don't think this time is any different. And that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in a bout of massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control. So you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf, right? But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf. But so do your savings. And so do anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right, in the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued, but then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation because there is not yet the need to regain that public confidence. But I watch that like a hawk because that, my friend, is the only thing that's keeping all of this stuff together.
The $50 silver level from 1980 remains important because it highlights how heavily manipulated these markets are. Just as gold and silver were once taken from the public and openly admitted to be manipulated by governments, today's spot prices don't reflect true price discovery, with LBMA inventories dropping sharply before partially recovering, while silver holdings remain much lower. This underscores silver's dual role as both an industrial and monetary metal, making it more vulnerable to hidden maneuvers. ETFs like SLV also expose this manipulation. Their structure was altered so they no longer need to back shares with actual silver. That leaves ordinary investors holding paper claims, while powerful players like JP Morgan or Saudi Arabia could still take delivery of the physical metal. This setup creates a backdoor way for institutions to control silver supplies, while the risks and losses are pushed onto the public, who falsely believe they own real silver through these trusts. Let's shift our attention towards the interview.
Yes, I definitely do think that triple digit price. Now, one thing that you mentioned about 80s with the Hunt brothers accumulating silver because they wanted to leave the US and form their own little country in Texas. However, the importance of that should not be just trivialized or ignored because what we were really dealing with was an overt manipulation by our government of the silver markets. And everybody was warned. And I have to say, Jesse, I have often wondered when these things that happened and they seem outrageous to me, like taking the gold away from the population, like taking the silver away from the population, like a sitting president admitting that they're going to manipulate the markets. And I used to wonder how they could get away with that, why people didn't rise up and say, no, you can't do that. That's crazy. Well, I think we're living through that right now. And I'm seeing it happen. I think there's a lot of blindness that's going on. So I do actually consider the $50 mark nominal, to your point, to a very valid point, because these markets are manipulated. They are admittedly manipulated. And so if anybody really expects there to be any level of good price discovery with spot gold or spot silver, and I always make sure I say spot because that is just a contract. And when you're talking about silver, there's a chart from the LBMA that they came up, and of course we know that there was a huge rush of physical coming into America at the beginning of this year. And you can see the stores in the LBMA dropping in gold, dropping and then rising again and coming back pretty close to the levels that they had before whatever came out of the LBMA. I'm actually more interested in what came out of the BOE, but let's just stay with the LBMA for a minute, because the same kind of issue with the physical metal being shipped over happened with silver as well, but their stores are significantly lower than they were before that physical push into the US. So what does that tell you? It tells you that silver gets used up in industry. And just like the SLV silver ETF that is supposed to be a basket of silver, they couldn't put the basket together. So back in, I don't remember whether it was 21 or 20, but they changed the prospectus. SLV changed its prospectus so that they didn't actually have to pull a basket of silver in, but rather all they had to do, which is what they were designed to do anyway, which is imitate the spot silver market. I think we could see that because silver is the secondary monetary metal, but it is rather, I'm pretty sure that Saudi Arabia would be considered an administrator, which means that they would, you and I can't do it, but they would have the ability to take possession of the underlying silver. So I think that is a manipulation to make that happen, because that can happen even more invisibly than what we were just talking about. And since silver is used across every single sector of the global economy, in solar, in medicine, etc., and gold is as well. Both of them are, but silver more so straddles that world. I think that this could also be a maneuver to ensure that they get their hands on the physical silver. At the end of the day, the holders of SLV won't. I mean, the normal holders of SLV wouldn't, but JP Morgan would and Saudi Arabia would. So I think it's a backdoor way to do it and have control of it. But the real problem is it would have to be done strategically. Like I'd be curious to see how much of a percentage of the holdings that they already have in silver that would actually represent. Because if they did take out the physical at the same time that SLV itself, that trust, is selling off bits of silver on a daily basis to pay the rest of the fees, the repercussions for the public would be huge. Those that think that they actually own silver with an SLV, they just own shares in a trust. But that could have some really significant significant impact on the risk transfer to the public.
The rise of digital currencies, the undervaluation of gold and silver, and the ongoing manipulation of precious metal markets all point to a fragile and shifting financial system. As fiat currencies weaken and hyperinflation risks grow, physical gold and silver remain the most reliable anchors of purchasing power, offering protection and opportunity during systemic transition. The real question is not if, but when this reset will force the world to rediscover the value of sound money. Do you think central banks will allow the public to benefit from gold and silver's true revaluation? How should ordinary investors prepare for a financial reset driven by digital money and precious metals? Please share your thoughts in the space provided for comments below. Please remember to subscribe to stay updated and to give this material a thumbs up if you found it helpful. We appreciate you coming along on the ride.